We've got George Thomas, who's joining us now to talk more about the construct of the market and his approach. George, afternoon. Thank you so much for your time. First of all, I'd like to understand from you, the global macro, which were very supportive for a long time for us. Now dollar index has gone back to 102, crude has gone back to 84, and we saw a jerk of FII outflow yesterday. Are we vulnerable now if any kind of a situation changes on a global macro front? Are we priced to perfection on the market side after the recent rally?
Yeah. So if I look at the valuations on a broader perspective, indices are trading somewhere marginally above their long-term median. So most of the sectors have run up quite sharply over the last few months, and that has reduced the margin of safety to a large extent. But in the current setting, from a global perspective, India continues to be in a favorable position. If you look at our current account deficit or even any macro parameter, it has substantially improved over the last 1-2 years. So from that perspective, India is favorable. FII money, as you said, is quite volatile. But what we have seen recently is, there is a very strong domestic flows, and the underlying economy is doing reasonably okay. So with these two parameters, it doesn't appear like there could be a material correction in the market. There could be profit booking in the near term, but it won't be a material correction.
That's a very valid point. It could be a shallow correction because the underlying strength of the economy is good. George, where do you see the maximum amount of opportunity on risk-reward basis in this market on valuation versus earnings argument? Which market is perhaps mispricing and missing it out?
Yeah. So three of our large weights are from financials, auto, and IT. So if you look at the financials, so the valuation bands are somewhere around their long-term historic median in most of the names and the names which we hold in our portfolio. And the financial cycle continues to be fairly favorable. The underlying economy is doing well, and that would reflect in the performance in these banks, be it credit growth or even the corporates have deleveraged significantly. So even the corporate balance sheets are fairly in a good cycle. So we don't see the risk of the asset quality turning adverse, at least in the medium term. Plus, the economic growth would ensure there is a reasonable credit growth. So that makes us positive on the financials bucket.
Mm-hmm. George, IT is something which is making me quite curious to talk more about with you, because you're one of the rare guys who's talking about IT. Everybody has underweight on it. Yesterday, the Q2 GDP data came in much stronger than what the street is estimating. Do you think current valuations are pricing in all the negatives? And if US economy is not indeed in such a bad shape as everybody thought, in next 2 quarters, things will rebound materially and could lead to some alpha generation?
Yeah. So if you look at the TCV wins or the deal wins of IT companies, they remain to be fairly robust. So typically what happens is, if the macro environment deteriorates substantially, the Indian IT service players gets a reasonable chunk of the business in terms of cost optimization deals or more outsourcing to control the cost of those corporate clients. But that kind of a material deterioration has not happened, and that is a result. That's the reason why we are seeing, despite those reasonable deal wins, that's not translating to revenue growth. So that is one part of the story. The other part is the clients are still not very optimistic or overly optimistic about their future, and therefore they have kept those critical projects or discretionary projects on hold. But what we have seen in IT historically is, if you underspend for some time, the need for that software and systems comes up naturally. And even the way business is run in the current environment, these IT systems are fairly critical. So at some point in next year, we would obviously see some kind of pickup in those IT names. But from a valuation perspective, it's not a very favorable situation. But with respect to broader markets, it's quite attractive. So one can consider building positions where that's at a deep discount to the fair value.
Mm-hmm. George, is it fair to make a basket of pharma stocks now, and with the assumption that perhaps the worst for pharma may be coming to an end? Over the next few quarters, we may see good earnings growth?
Yeah, that's a probable scenario. But if we look at the last 5 years, the amount of brands which has lost, brand which has come up for patent expiry is about $48 billion. And that number, I'm talking about the US market. So that number for the next 5 years is about $140 billion. So which is almost 3 times of what we saw in the last 5 years. Added to that, if we look at there are constraints in terms of inventory in the US market. And even although the consolidation has happened on the buyer side in the US market, there is shortage of drugs, which would ensure that the FDA might be kind of the planned issues and things. They are also in need for those drug delivery from India. So with that, the US story looks fairly robust. Plus, India is a growing market where you can expect growth in line with the nominal GDP or pretty close to that. So both put together, our sense is, even though the valuations are not very not at a significant discount to their fair multiples, there is reasonable scope for earnings improvement at least for the next 3-4 years.
George, what part of the value chain of power are you buying? Renewables, the legacy companies, power generation or power transmission companies, or it is the motors, the smart meters, the capital good kind of power ancillary? Which part are you most bullish on?
So we have a position in the power generation company. They are mostly into those thermal power capacity, where we believe at least for the next 4-5 years, the capacity addition should be fairly strong. Although the rhetoric has been the renewables could take over thermal to a large extent, but we still need a significant amount of thermal capacity to drive the electricity demand in the country. And as the economy progresses, that demand is only likely to become fairly strong. And to generate that kind of requirement from renewables may not be feasible. So renewables would have some portion, but even the thermal capacity addition would be fairly strong. So we are more positioned on the generation side.
All right, George, we'll let you go on that one. Thank you so much for chatting with us today. That was George Thomas talking about markets.